Let's summarize prepaid and accrued expenses with a couple of examples. Let's say at the start of the period, a firm had prepaid wages of $2,000. So they were paid last period and they're going to be consumed this period. Now, during the period, total payments for wages were $50,000. However, at the end of the period, there's $3,000 prepaid for next period. So this $50,000 payment here in the middle, that obviously some of that was used to prepay for next period. So what we need to do is figure out, well, how much would go on each of our reports. So to start off with the balance sheet, at the end of the period, the only amount that will be shown in the balance sheet will be the prepaid amount under current assets for next period, which is $3,000. We won't show the old prepaid amount because that's been consumed and therefore its balance would have already been used up. So what we're looking at is going forward, the unused economic benefits are $3,000 prepaid for next period. The income statement, what we're looking for is the expense consumed this period. So under other expenses, we'll take last period we prepaid $2,000. So this has all been used up. So we know that's going to be part of the expense, at least $2,000. Now we also need to factor in, we did pay for $50,000 this period, but $3,000 of that was actually for wages next period. So what we need to do is figure out, well, the total expenses paid for this period must be $47,000. And the reason is, we paid $50,000, but $3,000 of that was actually for next period. So together, if we used up the $2,000 that was prepaid last period, and then we paid $47,000 of wages that were incurred this period, our overall total will therefore be $49,000. Then we've got our cash flow statement. So what we need to record in there is all the payments of cash. So under operating activities, we will have wages paid. So how much have we paid in total? We paid $47,000 for wages this period. So how did we get that? We figured out that total expenses for this period of $50,000 paid, but $3,000 of that did relate to next period. So therefore $50,000 less our $3,000 prepaid. The wages paid for this period were $47,000. However, we actually have paid a total of $50,000. So what we need to record is a prepaid amount of $3,000 for next year. So our cash flow statement is going to show a total of $50,000. That's how much we paid. And that's going to be representative of these two amounts here. We paid $50,000 in total. $3,000 is for next period, so that must mean wages paid for this period were $47,000. Note that we've left out the prepaid wages from the beginning of the period because they were actually paid last period. Another example, let's say at the start of the period we had accrued insurance of $4,000. So what that means is that was incurred last period, but it's going to be paid this period. During the current period, payments for insurance were $30,000. And at the end of the period, we've got an accrued insurance liability of $3,000. So what we want to figure out is in our balance sheet at the end of the period, how much are we going to record? So at the end of the period, what we've got is $3,000 under current liabilities of accrued insurance. And the reason is we haven't paid this amount. It's been incurred but not yet paid. Now the reason why we left out the accrued insurance here was because presumably when we paid $30,000 this period, some of that must have been to take care of the accrued expense from last period. Looking at our income statement, we need to know the expense for the current period. So the first thing we can do is rule out this amount. And the reason why is that was an expense last period that was incurred but not yet paid. And while we'll pay it this period, it's not actually an expense that's going to be incurred this period. So what we'll do is figure out under other expenses insurance, we've paid a total of $26,000 for this period. So how did we get that amount? Well, we figured out we paid $30,000, but the first $4,000 of that, so let's say just this little bit here, that would have actually been used to pay the accrued from last period that was owing. So we do $30,000, take out the $4,000 that was incurred last period but paid this period, that's a total of $26,000. But we've also got accrued expenses that haven't been paid at the end of the period. So these have been incurred this period but not yet paid. So they are still an expense that we need to record. So looking at it in summary, we've got the $26,000 that's been paid for expenses of insurance this period, plus the $3,000 that's been incurred but not yet paid. The income statement is going to show total expenses of $29,000. Looking at the cash flow statement, well, we know overall that we have paid $30,000. So in this report, we're going to need to see the number $30,000. It's just a question of how it's split up. So under operating, we're going to have the following amounts: insurance paid of 26 and accrued insurance paid of 4. So looking at how we got that number, we looked at that we had the $30,000 total payment, but we remember that $4,000 of that was actually to pay off old insurance from last period. So therefore we write in here, we've actually paid back a liability called accrued insurance of $4,000, and that must mean the other $26,000 covered insurance expenses for this period, which were also paid this period.